When you're thinking about buying a home, one of the most important numbers you'll encounter is the mortgage rate. This rate is essentially the price you pay to borrow money from a lender, and it's expressed as a percentage of your total loan amount. It's a crucial figure because it determines how much you'll pay in interest over the life of your mortgage, which can be a commitment of 15, 20, or even 30 years. Unlike a one-time fee, the mortgage rate affects your monthly payments for years, shaping your financial future. Over the course of a typical mortgage, you'll make hundreds of payments, and the interest rate you lock in will impact every single one. That's why understanding how rates work is so important for anyone considering homeownership. Even a small difference in your mortgage rate, say just 0.5%, can add up to tens of thousands of dollars in extra costs or savings over the decades you're paying off your loan. For example, a lower rate means you'll pay less interest overall, freeing up money for other goals, while a higher rate can make your monthly payments significantly more expensive. A lower mortgage rate can make the difference between comfortably affording your dream home and having to settle for something less. It can open doors to neighborhoods you thought were out of reach, or allow you to buy a bigger home for your family. On the other hand, a higher rate can stretch your budget thin, or even put homeownership out of reach entirely for some buyers. That's why mortgage rates are watched so closely, not just by home buyers, but by real estate agents, lenders, and economists. These rates are influenced by a variety of factors, including the overall economy, inflation, and decisions made by the Federal Reserve. When rates change, it can send ripples through the entire housing market. When mortgage rates are high, fewer people can afford to buy homes, which often leads to a slowdown in the housing market. Sellers may have to wait longer to find buyers, and home prices can stagnate or even drop as demand cools. But when rates fall, the opposite happens. More buyers can qualify for loans, open houses get busier, and competition for homes can drive prices up. Lower rates can spark a surge in home buying activity, making it a hot market for sellers. That's why you'll often see headlines about mortgage rates. They're not just numbers for economists to analyze. They have a direct impact on your wallet, your ability to buy a home, and your long-term financial plans. Every change in the rate can mean a change in your future. The mortgage rate you secure will shape your monthly budget for years, affecting how much you can save, spend, or invest elsewhere. It's a decision that will influence your financial life long after you've moved into your new home. That's why understanding mortgage rates and how they're set is the first step to making smart decisions as a home buyer. By learning about rates, you can shop around, compare offers, and choose the best time to buy. Right now, mortgage rates are sending a signal to everyone watching the market. Whether you're ready to buy today or waiting for a better opportunity, knowing how rates work can help you make the right move when the time comes. This week, mortgage rates didn't just dip, they plunged, marking the biggest single-week drop in over a year. Freddie Mac reports the average 30-year fixed rate fell to 6.35%, down from 6.5% just last week. That's a meaningful shift, bringing rates closer to last year's levels and making borrowing cheaper overnight. Other sources, like Optimal Blue and Zillow, show similar or even lower averages. This isn't a minor blip, it's a market-moving event. The drop is pulling buyers off the sidelines and back into the market. The psychological impact of rates falling below 6.5% is huge, giving hope to those who felt priced out. It could be a turning point for the housing market. What caused this sudden drop? The answer lies in a complex web of economic signals, investor reactions, and policy expectations that have all converged in recent days. When the financial world shifts, it often happens quickly, leaving many people scrambling to understand what's really going on behind the headlines. At the center of it all is the Federal Reserve, the nation's central bank. Right now, all eyes are on the Fed and what it might do next. The big story? Expectations are growing that the Federal Reserve will soon cut its benchmark interest rate, a move that could ripple through the entire economy. Investors are betting big on a Fed rate cut, and their actions are already having an effect. As traders anticipate lower rates, they're shifting their strategies, moving money into bonds and other assets that benefit from falling interest rates. This activity is already pushing borrowing costs down, even before the Fed makes an official announcement. Mortgage rates don't follow the Fed directly, but they're closely linked to the 10-year Treasury yield. When that yield drops, mortgage rates tend to follow. It's a relationship that's crucial for anyone thinking about buying a home or refinancing. When investors expect lower rates, they rush to buy treasuries, which drives up bond prices and pushes yields down. As yields fall, so do mortgage rates, making it cheaper for people to borrow money for big purchases like homes. Recent economic data has added fuel to the fire. Reports show the job market is cooling, with fewer new jobs being created and some signs of slowing wage growth. This makes a Fed rate cut even more likely, as the central bank tries to support the economy and prevent a deeper slowdown. A weaker economy means there's less pressure to keep interest rates high. Businesses are hiring less, and some are even closing their doors. This environment gives the Fed more room to lower rates without worrying as much about inflation. It's a chain reaction. Weak job numbers lead to expectations of a Fed rate cut, which pushes down bond yields, and that in turn brings mortgage rates lower. Each link in this chain affects the next, creating a powerful feedback loop that can change the financial landscape almost overnight. For homebuyers, all these financial moves add up to one thing: cheaper home loans. Lower mortgage rates mean lower monthly payments, making it easier for families to afford the homes they want. It's a welcome relief for buyers who have been struggling with high rates in recent months. This is a clear example of how economic news and policy decisions can quickly impact your ability to buy a home. What happens in the world of finance doesn't stay there. It affects real people, real families, and real dreams. This week, the impact is real and immediate. For many, it's the difference between waiting on the sidelines and finally stepping into a new home. The recent drop in mortgage rates is like opening a floodgate for buyers who've been waiting on the sidelines, hoping for a better opportunity. For months, many potential home buyers have been watching the market, waiting for a sign that it's time to make their move. Now, with rates falling, that moment has arrived and excitement is building. Applications for home purchase loans have surged to their highest growth rate in years. Lenders are seeing a wave of new applicants as more people feel confident that they can finally afford the home they want. This surge is a clear signal that buyers are eager to take advantage of the new, lower rates. Lower rates mean buyers can afford more house for the same monthly payment. That could mean a bigger backyard, an extra bedroom, or a better location. For many families, it's the difference between settling and truly finding a place they love. But with so many buyers re-entering the market, expect more competition, more offers, and a busier market overall. Open houses are filling up again, and homes are receiving multiple bids, sometimes within days of being listed. For many, this is the window they've been hoping for. Lower rates can mean real savings over the life of a loan. Even a small drop in rates can save thousands of dollars, making home ownership more attainable and less stressful. It could be the difference between affording your dream neighborhood or not. Suddenly, that community with great schools or a shorter commute might be within reach, opening up new possibilities for families and individuals alike. But with more buyers, competition heats up, and bidding wars may return. Buyers should be prepared for the possibility of offering above asking price or making quick decisions to secure the home they want. Sellers gain leverage, so buyers need to be ready to act fast. Having your finances in order and pre-approval in hand can make all the difference in a fast-moving market. Lower rates are a big win, but the market will move quickly. Homes may not stay on the market for long, so being decisive and prepared is more important than ever. Preparation and speed are key. If you're thinking about buying, now is the time to get ready. Do your research and move confidently when the right home appears. Let's see what a rate drop means for your wallet. On a $400,000, 30-year fixed mortgage, a 7% rate meant a monthly payment of about $2,661. That high payment kept many buyers out of the market. At the new average rate of 6.12%, your payment drops to roughly $2,429, a savings of $232 a month. Over a year, that's $2,784 saved. Over 30 years, more than $83,000 in interest. That's a life-changing difference for many families. Even small rate changes have a huge impact over time. The recent drop has made home ownership more attainable for thousands. That's why mortgage rates matter so much. Lower rates help, but they're not a cure-all for housing affordability. Home prices remain high, so even with cheaper borrowing, buyers still face big loans. More buyers competing for limited homes can push prices up, offsetting some savings. Many homeowners with ultra-low pandemic rates aren't selling, keeping inventory tight. So, while lower rates are great news, challenges remain. Buyers need to be realistic and prepared for competition. The affordability crisis isn't over, but one big hurdle just got lower. Even as average rates fall, your personal rate depends on your financial profile. Shop around. Get quotes from multiple lenders, not just your bank. Comparing offers can save you thousands over the life of your loan. Lenders look at your credit score and debt-to-income ratio. Aim for a credit score of 740 or higher for the best rates. Pay bills on time, reduce credit card balances, and avoid new debt before applying. Keep your debt-to-income ratio below 36% if possible. Pay down debts or increase income to improve your profile. A strong financial profile is your best tool for negotiating a lower rate. Take control. Preparation pays off. With rates dropping, everyone wants to know, will this trend last? Most experts say the Fed's next moves will be key. If they cut rates, mortgage rates could fall further. But the relationship isn't always direct. Sometimes rates move for other reasons. The consensus: we're unlikely to see pandemic-era lows, but the era of 7% plus rates may be over. Expect rates to stabilize or ease slightly through the end of 2025. A gradual decline is more likely than another big drop. Looking to 2026, rates could drift a bit lower if the economy stays steady, but as always, surprises can change the outlook overnight. This week's rate drop is the best news for buyers in over a year. Lower payments and long-term savings have reignited the housing market, but high prices and low inventory remain challenges. Buyers should prepare for competition and act strategically. Now is the time to check your credit, pay down debt, and get pre-approved. Shopping for the best rate is essential. Don't leave money on the table. The financial landscape can change fast, so be ready to move if the right home appears. For now, the door to homeownership is open a little wider.